Hello, everyone, and welcome to an introduction to Nadex short-term trading products. My name is Todd Rich. I'm head of education here at Nadex, and I will be taking you through today's presentation. First up, I am going to let you know that this session is being recorded, and you will be able to get access to the recording so that you can review this again at your leisure. It'll be available both on the Nadex website as well as on the Nadex YouTube channel. Before I jump into it today, I do need to share this disclaimer because all of our webinars are sponsored by our compliance department. And I need to share that trading involves risk and may not be appropriate for everyone, that any trading decisions you make are solely your responsibility and at your own risk. And this is an educational session. Please do not construe anything I say as a buy or sell recommendation. We are doing this for your education purposes. And that'll become abundantly more clear when I move over to the platform, which is what I like to call the off-roading session. And I demonstrate how these products work and how you can trade them using the Nadex platform. A little bit about me. I like to put this up briefly. I don't always do this, but some people do want to know who is speaking. I did join Nadex in 2019. I have been in the financial services space for quite a long time. I started as a trader on the floors of the Chicago exchanges, which, by the way, really the floors don't exist anymore. The Chicago exchanges are all merging, and there's rumors that there might be another merger. That rumor broke yesterday. But I did spend years on the exchanges, and then I was trading, and then I actually went to work for the exchanges and brokerage companies with many years, like 5 years at Eurex, 4 years at Box Options Exchange. It was the Boston Options Exchange. 5 years at the New York Stock Exchange, 4 years at E-Trade. So I've really got a very broad background in financial services, whether it's retail brokerage or at the actual exchange level. I do have a BA from UCLA as well as my MBA, a true blue Bruin. That's what happens when you grow up out in California and then move to Chicago. Now, what is our agenda for today? And we are going to cover all of Nadex products. We've got 3 of them. And I'm not going to be doing a deep dive into any one of them. I would like to give you an overview because we have so many people who are new to Nadex. And in fact, I'm going to define Nadex first. We are going to spend a minute or two there because it's why everyone who is on this webinar right now is here. You're probably a retail trader looking for short-term trading opportunities, and I need to get into just who Nadex is to begin with. Then I will go through our 3 products. I will be spending a little bit more time probably on binary options because it's the primary reason that people end up at Nadex. But it's nice to know that we have these other products as well called knockouts and call spreads, which you may like, also designed for short-term retail trading. I will go through examples of each, and I will be doing a practical demonstration on the Nadex platform. So you will get to see some of the tools in action. It will not be a deep dive into all the functionality that the platform has, but we do individual sessions where I'll usually have Adam McCaden, one of my colleagues, who will go through the entire platform and share with you all of the functionality that is available there. But we will certainly get into the basics of it so that you can get in there and start clicking around. Who is Nadex? I am going to do this one relatively quickly because I want to spend more time with the products. But Nadex is an acronym, as everything in the financial services are. We love our acronyms. It's an acronym for North American Derivatives Exchange. And what is important is that Nadex is a regulated exchange in the United States. Another acronym, we are regulated by the CFTC, which stands for Commodity Futures Trading Commission. Now, why that is important, we are a proper exchange in the United States, and we are properly regulated. We have to adhere to all the rules, laws of the United States, and we do have regulatory oversight. Now, I mention that because if you were to look for binary option providers on the internet. One, you may find some that are offshore that you might be able to access if you put a blocker on your internet so that they didn't know where you were. And you'll often find articles about how there are nefarious actors who do things in the binary option space where people, for instance, put money into their account and then can't access it or get it back out. None of that applies to Nadex. Nadex is a proper exchange in the United States, and we are regulated by the CFTC. And that is the same regulator that regulates the CME, the Chicago Mercantile Exchange, a very large exchange, as well as ICE, the Intercontinental Exchange. And the Intercontinental Exchange bought the New York Stock Exchange. So we have that same regulatory oversight as some of those larger exchanges. And what does Nadex provide? We offer contracts designed for retail traders. I mean, there's some words on here that I really highlight. There have been a massive influx of retail traders into the trading space, particularly a boom around COVID and people getting online and having more time and people wanting to take a more active role in trying to build wealth. And you're hearing about small notional value contracts that are being offered elsewhere. Nadex has been around for over a decade. We were an early mover into the space. And what do I mean by contracts designed for the retail trader? It's two things: low cost to entry. You do not need thousands of dollars. You can do so with tens of dollars or hundreds of dollars and access Nadex markets. And the other thing is defined risk. Defined risk. You know what you are getting into before you enter a trade, what you could potentially make, what you could potentially lose. There are no surprises. You're not going to have one of those instances where you put on a trade and then you lose your entire account and you lose more than what's in your account, and then there's maybe a margin call. That's simply not part of Nadex. And you hear about people losing more money than they have. It's essentially bumpers on all your trades where it's got clearly defined risk. So you know what you're potentially getting into beforehand, and you cannot lose more than what you initially put into a trade. All right, and then we do offer contracts where people are looking for short-term price action. And we've got binary options, knockouts, and call spreads, and we're going to go through all three of those. Oh, by the way, I wanted to share this quickly because we have a lot of new folks, and you might not be aware of this. If you've been around Nadex for a while, sometimes people have been around Nadex for a while aren't fully aware. But we do have a refer a friend program. You have your own personalized link if you have a live account. If you don't have a live account, you won't have this personalized link. But if you shared that link with your friends and they signed up using that link and they placed 5 trades within 30 days of applying for their Nadex account, they'll get $100 into your account. You'll get $100 into your account. So it's, like Oprah. You get $100. You get $100. Everyone gets $100. You can invite up to 10 of your friends, which means you could end up having $1,000 in your account. And we find that a lot of retail traders do like to trade with their friends because they can share ideas and help each other out. So I do like to point that out quickly. Now, by the way, this is an interactive session. On the right-hand side of your platform, there's a little question mark. If you click on that, you'll see that you could type in a question and send it to me. I will do my best to review all those questions as we go. And if I don't get to all of them, I will try to take a peek at the end. But I do want to ask, I'm going to, if you have any questions, please ask. And in fact, just for fun, if anyone's got a product that they would like me to demonstrate, binary option, knockout call spread, or a market, the Dow Jones, the gold, oil, a foreign exchange pair, you can type it in. I'll use that as an example when we get over to the platform. So if you want to, go ahead and just type that in, and I will pick one of those when I get over to the platform side of the demonstration. Now, what are binary options? We're going to start at the beginning. And binary options are short-term defined risk-reward contracts. That's the first thing. And it is a contract. And I know some people go, well, what does that mean? And I'll get into that in a moment. But it's just a short-term trading opportunity. And that contract, which we'll talk about why it's a contract, is made up of three components. All right. There's a statement or a prediction. I personally like to think of it as a prediction. And for a binary option, it's a prediction and it's got three components: an underlying market, the condition, and an expiration time. So when I say it's a prediction, and let's just use the Dow Jones Industrial Average as an example for now, because the equity indices are a bit volatile today. I've got my underlying market, the Dow Jones Industrial Average. The condition: will it be greater than 34,500? All right, that's the condition. That is sometimes called the strike price or the level. So you'll often hear strike price. It's a bit of a buzzword. So it's just the level that defines the prediction. Will the Dow Jones be greater than 34,500? And then there's an expiration time: in the next 20 minutes, in the next hour, in the next 2 hours, at the end of today, at the end of the week. We've got a variety of expiration times so that you can choose the market, the condition, and the expiration time that suit your opinion. All right, so you get to customize your trade that fits what you are predicting. Now, with that prediction, this is why it's a contract, and something else that differentiates Nadex is you can either buy or sell this prediction. And it doesn't matter whether you're buying or whether you're selling, the risk and the reward are both capped. You know what you're getting into before you enter the trade. What could I potentially make? What could I potentially lose? And here's that prediction. Now the reason I mentioned it's a contract, it's because you can either buy it or sell it. That is something that differentiates Nadex from other binary option providers, is you can also pick the direction. And I'm going to get into what that direction means in a second. But then the other thing that's important to know is it will trade. You're going to see a price on a binary option, and that price will trade between 0 and 100. And we're now going to talk about what that price represents, but it's a short-term contract, 20 minutes. It can be 5 minutes, 20 minutes, an hour, 2 hours. So short-term. It's a prediction, an underlying: will the Dow Jones be greater than 34,500 at the end of today? Will gold be greater than 1780 in 2 hours? So it's a market, a condition, and an expiration time. And I can buy it or I can sell it. Okay, now what does that mean? What is buying and selling this contract represent? So when you talk about a binary option, it's essentially a true or false prediction. Either at expiration, the event happened or it didn't happen. Either the Dow Jones Industrial Average closed or finished greater than 34,400 or it didn't. It's true or false. It's yes, it finished above, or no, it did not finish above. Now, if the statement is true, if the Dow Jones at the expiration time that you picked finishes higher than that price, the option will go to 100. And if it's false, the option will go to 0. All right, so you're trading a number between 0 and 100, and in the end, it either goes to 100 or it goes to 0. That is why it's a binary option. It's either or. It's true or false. It's yes or no. And it's essentially all or nothing. It goes to 100 or it goes to 0. Now, what does that number represent? And that number represents two things. Okay. First, and let's talk about what you're actually trading, is that price. The price that you see for a binary option can be thought of as generally reflecting the probability of the event being true as determined by the marketplace. So if I see a binary options trading at around 60, the market is saying there's a 60% chance at that moment in time that it will go to 100 and the event will be true. Now, that also means there's a 40% chance that it will be false and it will go to 0. If I'm trading a binary option that's trading at 20, at that moment in time, the market is predicting, or the market is pricing a 20% probability that it will go to 100, that the event will be true, and an 80% chance, because it's got to add up to 100, that it will be false. Now, that's the first thing, is you've got to understand the probabilities. Now, we give you those probabilities. You don't have to calculate them. We show it to you. I just want you to understand that that's what the price is. And let me give you an example. If gold were currently trading at $17.80 per ounce, and your binary option question is, will gold be finish higher than $17.80 an ounce at the end of today, and it's currently at $17.80, there's an equal chance that it would go finish above, and an equal chance that it would finish below. It's a 50-50 chance. I don't know what it's going to do. I don't know if gold's going to settle higher than the price, or if gold is going to settle lower than the price. So at that point in time, the market would probably be pricing this right around 50, meaning there's a 50% chance that it will be true. It also means there's a 50% chance that it would be false. Now, if you thought the answer were going to be true, you would buy the binary option. So you buy it at 50, hoping it goes to 100. If you think it's going to be false, you can sell it. And that's why it's a contract. And some people say, well, how can I sell something I don't own? You're trading a contract. I can sell this, and what I'm really doing is predicting that the statement will be false, and I'm looking for it to go to 0. So you buy a binary option if you think it's going to be true. You sell it if you think it's going to be false, and that price is, at that moment in time, the price you're seeing is the probability that the market is pricing it in that it will ultimately be true. Now, there's something else that number represents. And by the way, there's something else I didn't point out there. Similar to other options, if you happen to trade other options, like for instance, calls or puts, and I'm not going to get into all that. Similar to that, the time to expiration and the volatility of a contract will be factored into that price. If there's a lot of volatility and the market can't really predict where it might finish, more of the probabilities will hover toward 50. If there's low volatility, the prices will be a little bit more distinct. And time to expiration, if there's a lot of time to go, there's still opportunity for things to move around and things to change. So time to expiration and volatility will be factored into those probabilities of it potentially being true. Now, I mentioned that first number, that a binary option you're trading is the probability of it potentially being true. It is also the dollar amount. We made it easy for you. So while a binary option at Nadex trades between 0 and 100, we made each binary option contract worth a maximum of $100. So when you are trading a binary option, if you bought one at 40, you think it's going to go to 100. Now the market is telling you there's a 40% chance at that moment in time that it will go to 100, and all it has to do is finish above that price. It doesn't matter if it finishes 1 penny above that price, or $50 above that price, or $200 above that price. As long as it finishes above that price and the statement is true, it will go to 100. And if it finishes at the price or lower, it will go to 0. It will be false. Now, if you bought one at 40, it's going to cost you $40. You're going to risk $40. And what you're hoping is that the statement is true, that it settles at 100, and you would make $60. You would risk 40 to make 60. Now, if you thought it were going to be false, if you thought it were going to be false, you can say, hey, there's only a 40% chance of this being true. I think it's going to be, that means there's a 60% chance it's going to be false. You can sell it at 40. You can sell at 40. Now, your risk is that it goes to 100. If you sold it at 40 and the statement becomes true and it goes to 100, you would potentially lose $60. You're going to have to put up 60 to potentially make the 40, because if you sold it at 40, your goal is, or what you're hoping is that it goes to 0. So it doesn't matter what your perspective is. You can buy or you can sell. Your collateral, what you put up for a trade, is your maximum risk. If you buy it, it's the price that you paid for it. If I buy one at 80, I'm going to have to put up 80. If I buy one at 20, I'm only going to have to put up 20. And if you sold one, it's the difference between 100 and the price you sold it at. And that's interesting, is that you can either predict it's going to be true, or you can predict that it's going to be false. And then your reward would be the exact opposite of that. Now, I'm giving you all those numbers, but when it comes to Nadex, you don't need to calculate your probabilities, and you don't need to be trying to figure out what you could potentially make or what you could potentially lose, because we do that for you on the order ticket. So I am now going to show you an order ticket, and this is why, we make it easy for you. We want to help you, and so that you understand exactly what you're getting into before you enter a trade. On an order ticket, and here's the order ticket. Let's go through each of the pieces. First of all, in the upper left-hand corner, there's an indicative price of the underlying. Now, this happens to be for the US 500. So this is for the S&P 500. So we have a prediction. And we have a current indicative price of the S&P 500. It's 43.50. It's 43.50. And we have an expiration time, an hour and 23 minutes from now. So we know where it's currently trading, and we know it expires in an hour and 23 minutes, and we have our prediction. Will the S&P 500 be greater than or finish higher than 43.54.50 at 1 p.m.? Now, I know the indicative price is 43.50.63 right now. That is below 43.54.50. It is lower than that price. So currently, this binary option has a price below 50. It's trading, and if you look at the middle of that bid-ask spread, it would be around 33. In fact, it's 33.75. Now, that means the market is predicting there's a 33.75% chance that it will finish higher than 43.54, right? That means there's a 64% chance it will not. Okay. Now, on that order ticket, there's a bid and there's an offer. You do not have to use those prices to trade on. If I wanted to buy, I know I could buy one at 36.75. I know, because there's an offer here to sell one at 36. So if I wanted to buy one, I could certainly buy one there. If I wanted to sell it, I could sell one at 30.75. And this is a buy order. This is a buy ticket because I have buy lit up in blue. If I were looking to sell, the sell would be lit up in red. Now, in this instance, I could try to buy in between the bid-ask spread, 35.50. Okay. Now, will I necessarily buy one at 35.50 if I put this order in? Not necessarily. I would become the best bid. So right here where it says 30.75, this number would immediately change to 35.50. I will demonstrate this for you. And if someone wanted to sell one, they'd have to sell it to me. I'd be the person there. I'd be making the market. Now, I mentioned to you, you don't have to do the math on what your potential risk and reward are. We put your maximum loss and your maximum profit right on the order ticket. If I were to buy one at 35.50, and I could try to buy one at 35.50, someone else would have to want to sell it to me. If I bought one at 35.50, that is what I'm risking. I cannot lose more than $35.50 if I bought one of these. And what could I potentially make? Well, it could go to 100 and I could make $64.50. Now, of course, it's below Currently, we're at 43.50 and we're currently below my prediction level. It would have to go all the way up to 43.50 and a half, 43.50 for it to even become a 50-50 proposition. But it's a lower probability trade, but I think it's going to settle higher in the next hour and 23 minutes. Now, what we also give you on the order ticket is your maximum return on investment and your probability of your trade being in the money. Now, I mentioned these probabilities. You can look at this and see that if I were to buy one, it's a 33.75%. If I were to sell one, my probability of success would be higher because it's already below. We calculate these probabilities for you. You'll see it on the order ticket. I will demonstrate it to you. And the return on investment, if I were to buy one at 35.50 and it went to 100, I'd be making 166% return on my money. If this ends up being true and it goes to 100 in an hour and 23 minutes and this finishes above 43.54.50, I'd be making over 100% return on my money, which is a great return. That's me predicting it's going to go up and finish higher. Now, remember, it could finish anywhere higher. Anywhere higher than 43.54, it goes to 100. At 43.50, 43.54.50 or lower, it goes to 0. Now, I am holding back one really important thing, and I'm not going to tell you quite yet. I'm going to make you wait for it, but it's important, really important when trading binary options. I just want you to be paying attention because now we're going to quickly cover knockouts and call spreads. I want you to understand these products, and I'm doing an overview of all three of them, and I know it's a lot. I will spend some time on the platform showing this all to you as well. Now, what is a knockout? A knockout is also a contract. All right, everything we have is a contract, and that is because you can buy or sell any one of these. You can take a long position or a short position on any one of our products. Now, a knockout is a contract and it has a price and it will trade between two price levels. They are predetermined price levels. The lower price level is called the floor. The higher price level is called the ceiling. And the contract itself will trade between the floor and the ceiling. Now, the price that you're actually looking at is the price of the underlying. So unlike a binary option where you're trading the probability of something finishing above a price or the probability of it finishing below a price, with a knockout, it's what we call a delta one product. You are actually trading the price of the underlying. So if I'm trading gold, and gold we're trading at $17.90 an ounce, if I thought gold were going higher, and this is probably our most intuitive product, it's just like any other market. If I thought gold were going up, I buy it. And what am I buying? I'm actually buying the price of gold right here, $17.90. I buy it. I think it's going higher. If I thought the price of gold were going lower, I could sell it and take a short position. I'm not actually trading gold. I'm trading the price of gold. That is why it's a contract. If I thought the price of gold were going lower, I can take a short position. I could sell it at $17.90, looking to profit if the price of gold were to go lower. And a knockout will trade between the floor and the ceiling. Now, a knockout will settle in one of two ways, where it will finish. This is how a knockout works. It will expire either by price or by time. Now, what does that mean? Let's first talk about price-triggered settlement. If the underlying market, if the price of gold were to touch the floor or the ceiling of that knockout expires and settles immediately. You are knocked out of the trade. That is why it's called a knockout. You get knocked out of the trade if it touches the floor or the ceiling. So if I bought a knockout and I thought the price were going higher, and again, I'll stick with gold. If I thought gold were going higher and I buy the knockout and I am wrong, I am absolutely wrong, and it goes down and it touches the floor, I get knocked out of the trade and I just experienced maximum potential loss. I bought it It went against me. I knew what my risk was. It's defined. I know the maximum I could potentially lose, and that would be it goes down and touches the floor. It just knocks you out. Now, on the flip side, if I buy a knockout, I think gold's going higher and it trades up and it touches the ceiling. All right. It touches the ceiling. I get knocked out of the trade, even if it comes immediately right back down. It doesn't matter. It went up, it touched the ceiling, I got knocked out. You've got clear exit points when you trade a knockout. The floor and the ceiling, it will knock you out of the trade. If you think the price of something is going lower and you sell it, if it goes down and touches that floor, you're knocked out of the trade, maximum potential profit. If it keeps going lower, you cannot make any more money, you're already knocked out of the trade. If you sell it and you're wrong and it goes higher and touches the ceiling, you're knocked out and you experience maximum potential loss. Now, the question is what happens because there's an expiration with our contracts. What happens if it doesn't touch the floor or the ceiling? Well, at the end of the week, and our contracts, our knockouts are set up as weekly contracts. At the end of the week, it will settle at a price, right? And then it'll be a time-triggered settlement, all right? And your profit or loss will be the difference between where you bought or sold it and where it actually settles. So if you buy a knockout and it trades between the floor and ceiling and it never touches either one of them, at the end of the week, it will settle at a price between the floor and ceiling, and your profit or loss will simply be the difference between where you bought it or sold it and where it settled. If you bought it and it settled higher, you would have a partial profit. If you bought it and it settled lower, you have a partial loss, and vice versa if you sold it. If you sold it and it went up and settled higher, you'd have a partial loss. You never got knocked out for maximum loss because it never touched the ceiling. But if you sold it and it went down and it never touched the floor for maximum profit, you would have a partial profit. I am going to show you a quick actually, here's the thing about knockouts, and this is what I really want you to think about a knockout. Actually, a question just came in. It's sort of like a trade plan, and and it's exactly like a trade plan. So you got this right away. So 100%, you know what your potential maximum or profit are before you place the trade, and that floor and ceiling give you those natural profit targets, and it gives you a natural profit target and a natural defined risk control. So it really is. It forces a retail trader to be structured in how they approach a trade. When you buy a knockout, your profit target is if it hits the ceiling. And you have to know, all right, where would I potentially get out of this trade for a profit? And even if it goes higher, you're okay with that because you made a profit on your trade. And where is your stop loss? How tight do I want my stop loss to be? If I buy it, how close to the floor do I want that to be so that if I'm wrong and it goes down, I want to get knocked out and just go, oops, I'm wrong. Stop me out. Get me out of this. I bought it. I thought it was going higher. I don't want to risk any more than a certain amount. You would pick a knockout with a floor that minimizes your risk. And it goes the other way. If you're selling, if you think something is going lower, I think gold is going lower, I'm going to sell gold, I might choose a knockout with a low ceiling so that if I were wrong and gold were to actually go up and, okay, I didn't predict this correctly, get me out of this trade. I sold it. You're going to get knocked out for maximum loss if it touches that ceiling. You might want to choose a knockout with a low ceiling. And we offer 4 knockouts for each contract so that you can pick the risk-reward ratio, the risk-reward ratio that suits your opinion. All right, so that's for knockouts. I'm also holding something back with knockouts. So I'm holding something back on purpose. So you're going to have to wait for it. Now, a quick review of a knockout order ticket. You've got your indicative price. This is the NASDAQ, the US Tech 100. It's currently trading at 13,074 in this particular example. And it's got 3 days till expiration. And we've got a range, 1352 to 13202. So it's got this range. It's got a floor of 1352. It's got a ceiling of 13202. It's currently trading 1374, and you can, I mean, a pretty tight market here. I can buy or I can sell it. All right. And again, I could place a bid or an offer in between here. And I'm going to go through some examples, and I will have opportunity to show you this. And here, if I were to try to buy one in between at 13,073.50, so you're actually trading the price of the NASDAQ. I'm not doing a probability. I'm actually trading the price. It's a Delta One product. If I bought this at 1373.50, I've got my floor at 1352. If it went down to 1352, I would lose $86. I would get knocked out. I cannot lose any more than $86. So for me to do this trade, I would have to put up $86. I cannot lose any more than that. And I know where my maximum potential loss would be. Now, where's my maximum profit is it goes all the way up to 13,202 in the next almost 4 days. And if it went up and it touched the ceiling, I would make $514. So what I've done here is, I mean, this was a prediction. I'm buying the Nasdaq. I'm going long. Now, if I just wanted to buy it, I could just buy the offer price, and I know exactly what I could potentially make and what I can potentially lose before I enter the trade. And I'm still holding something back. We will get into it in a second. I want to quickly cover call spreads, because if you understand knockouts, you will definitely understand call spreads. Because knockouts, again, is a review. Binary options, you are trading a probability, a yes or no. Is it going to go to 100 or is it going to go to 0? Is it going to be true? Is it going to be false? Knockouts, Delta One, I buy the price. This is the price of the underlying. If I think it's going up, I buy it. If I think it's going down, I sell it. And I have very hard, distinct knockout levels. If it touches that floor or it touches that ceiling, I am knocked out of the trade. Now, a call spread is very, very, very similar to a knockout. So if you understand knockouts, you're going to understand call spreads. They are also a contract with a predefined range, with a floor and a ceiling. And the price of a call spread will move in line with the underlying, similar to knockouts, but not the same. Not the same. And that is because call spreads differ from knockouts in 2 ways. All right. The 2 ways that a call spread is different from a knockout. Number 1, and this is really important, there is no price-triggered settlement. There is no price-triggered settlement. It only expires at expiration. So a call spread, you buy or sell a call spread, it touches the floor or the ceiling, you are still in the trade. You are not knocked out. So you've got plenty of time for your prediction, your trade to be potentially right if it goes against you. Now, because you have that optionality, so if I buy a call spread and it touches the floor, with a knockout, I would have been knocked out. With a call spread, I'm not knocked out. I've got time for it to potentially turn around and come back. You know, some people love knockouts because they just want to be done with the trade. Out, get me out, I'm wrong. Others like, well, every time I do this, it touches that floor and then it goes higher right afterwards. I don't want to get knocked out. I want to have that optionality. Well, with that optionality comes at a premium. Volatility and time to expiration will impact the price of a call spread very much like they impact the price of a binary option. So the prices that you buy or sell call spreads at are going to have a premium baked into them. Now that works really well when you don't get knocked out for maximum loss. I sell a call spread, it goes up, touches that ceiling, I'm still in the trade, it keeps going higher. I cannot lose more than what I initially put into the trade. I knew that when I sold it at the beginning. I knew what my maximum risk was. Now, if it comes back and it goes down, and I have time for it to be right, and it could potentially go lower if I sold it, I have time for my trade to be right. If I buy a call spread, I think something's going to go higher. I buy it and it goes down at first, it touches that floor, I'm still in the trade, and then I can't lose any more than what I initially put in. You can never lose more than what you initially put in. It keeps going lower, you can't lose any more. You knew what you can lose when you bought it. But if it comes back higher, you have time for it to potentially be right. And if it goes higher, you might have a profitable trade. But that comes at a cost. There is going to be a premium. Now, I told you there was one thing I was holding back, and this is true for binary options, knockouts, and call spreads, and this is really, really important. If you take nothing else away from this, this is critical. Alert, alert, alert. An important rule when trading any of Nadex products, right? Because they all have an expiration. But just because there's an expiration time and date associated with the contract does not mean you have to wait until then to see what happens. That is so important. And I'm going to say it again. Just because there's an expiration associated with the contract does not mean you have to wait to see what happens. You can exit a trade early. In fact, many successful traders exit their trade early. They don't wait for expiration. They don't wait to get surprised for it to make a move. You can exit your position early. Why would you want to do that? You'd want to do that for two reasons. One, you want to lock in profits. All right. I did a trade. It's a profitable trade. I'm going to take that trade off, take my profits. Thank you very much. Move on to the next trade. I'm not looking to get absolute maximum reward. I'll take a partial reward and move on to my next trade. The other reason you would exit a position early would be to limit losses. I did something, I was wrong. I don't have to take all my lumps. So let's just walk through a little example. Theoretically, a binary option, it's trading at 40. There's a 40% chance that it's going to finish in the money, that it's going to be a true statement. You buy it at 40. Now, you're wrong. The price starts dropping, time goes forward, and next thing you know, that binary option is only trading for 20. Do you have to lose all $40? You knew you could potentially lose $40, but you don't have to lose all 40. You bought it at 40, it goes to 20. You can say, forget it, I'm out, sell it at 20, take your lumps. I only lost 20. I limited my losses. I'm able to move on to the next trade. Similarly, I bought it at 40. I was right. It went up. Now it's trading at 80. This is great. I've now doubled my money. It's now trading at 80. Do I want to wait and see what happens? There's still a 20% chance that it could finish below the strike. I don't know what's going to happen. There's still a chance. If you bought it at 40 and you sell it at 80, you would have made $40. You'd be locked in. Now, did you leave $20 on the table? Maybe. Did you get maximum reward? No. Are you okay with that? Sometimes you lock in your profits, say thank you very much, and move on to the next trade. So you can exit all of these early. Now, with a call spread, that really becomes important. That really becomes important because remember with the call spread, and this is, this is absolutely critical. And this is true for knockouts too. I buy a knockout or a call spread. Now, with a knockout, if it touches the floor, I'm knocked out because I bought it. With a call spread, I'm not knocked out, but let's say it goes higher. All right, I'm not knocked out of either one of those positions. It goes down a little bit, but it comes back. It never touches the floor ceiling, the floor, and it goes higher. I'm making a profit. I'm making a profit. Do I have to wait until expiration to lock in those profits? No, I can sell a knockout and take my profit. I can sell that call spread, and in fact, you might really want to sell a call spread because think about this. Just like you have time for it to be right, if you initially predict wrong. I buy a call spread, it goes through the floor, but then it comes back, it goes through the ceiling. It takes off. You were totally right. Yes, this is great. You're still in that trade and it goes up. You can't make any more money. The only way for you to get out of that trade is for you to sell it and take your profits. Or you wait until expiration, and by then it may have come all the way back down. That really, you made a right prediction. It gave you maximum or near maximum profit, but you never got out of it. You never rang the bell, and then it came back against you. So with call spreads, you have to pay attention to that. While it helps you when you're wrong, because it gives you time for your trade to be right, when you're right, you need to exit your trade. You need to put in an order to exit your trade when you're right and collect those profits. You don't need to wait until expiration to see what happens. that actually finishes this portion, the slide deck portion. I'm going to spend the next 15 minutes on the platform. If anyone would like a copy of this slide deck, email customerservice@nadex.com. If you email customerservice@nadex.com and request this slide deck, tell them you're looking for the intro to Nadex short-term trading products from today, and it's August 19th, in case you're catching the recording, you can email and they'll send you a copy of the slide deck. And I think I got everyone's questions, but if you have additional questions afterwards when you're reviewing this, please email customer service. We are also on social media. On all those, you can follow us. I highly recommend you follow us on YouTube. I really recommend that you follow us on YouTube. The reason I recommend you follow us on YouTube, one, we're constantly pushing out content. This recording will be available on YouTube. It will also be available on our website in our learning webinars section. And then every morning at 8:45 a.m. Eastern, 8:45 a.m. Eastern, 7:45 a.m. Central, 45 minutes before the equity markets open, we live stream. We live stream usually for about 15 minutes, and we discuss what happened overnight, what events might happen during the day, where are potential hotspots where you might want to focus. We do some analysis and some technical analysis on charts and just try to get you set or help you get set for what you might want to be focusing on for that day, and maybe trying to identify potential binary options, knockouts, or call spreads. We live stream every morning. Those live streams immediately get posted to our YouTube site under the live streams. You can go back and listen to this morning's or yesterday's if you wanted to review some to kind of hear what we do, but we live stream them. You can come join us live every morning for about 15 minutes. If you're not able to catch them, they are immediately posted. You can watch those recordings. And we even do a quick little write-up, a quick little synopsis underneath it to help you digest what's going on in the markets. What are some potential hotspots? What's moving that morning where you might want to take a look for some potential opportunities? All right, I am now going to jump over to the platform because I do want to spend a little bit of time demonstrating and showing you. I mentioned my mom was born in Missouri, or if you want to pronounce it right, Missouri. It's the show me state. So let me show you. I want to show you. We're going to start off with binary options. All right, when I click on binary options, you'll see that we've got, and by the way, I am in a demo environment. If you don't have a demo account, I recommend you have a demo account. It doesn't cost anything. This is practice trading. It will not be the same as live trading because you've got different people in a demo environment than you do in a live environment. So there's not as many eyeballs, and people also can do crazy things in a demo environment that they would not do in a live environment, like buy 500 contracts if they could. People wouldn't necessarily do that in real life. So your experience in demo will be different than live. Now, we do have 5-minute binary options. They are all in foreign exchange contracts. And, we've got these expiring in a minute. I might come back and look at 5-minute binary options. We also have 20-minute binary options in the indices. And in fact, here, I'm going to bring up the Wall Street 30, the Dow Jones, and I'm going to just go ahead and populate a chart. Let's hide this. Let's really get a look at this chart. I'm going to zoom in and make this chart bigger so I can see what's going on. Oops. You know what? Let's make this an hourly chart. That's going to make it a little easier. Okay. Wow, there's so many strikes over here. And if I want to see all the strikes, I can certainly show them all. There'll be these dotted lines. Here, I'm going to try to open this up a little bit so you can see all these dotted lines. Yeah, even then, there's just so many different, there's all the strikes. And you can see the probabilities. Notice when there's this much time to expiration, here's all the probability. I can be making predictions for the next 10 minutes on where the Dow Jones. It's currently right here at 34,890, right near 34,900, 890. And notice how this is trading right around 50%. If I wanted to buy one, it shades the chart red on where it would have to finish. Blue, anywhere in the blue. and this contract goes to 100. If I thought it were going lower, anywhere in the red, it would go to 0. Now, I am going to show you. Look how here's the order ticket on the right-hand side. All right. If I click buy, notice how it gives me the probability of me being in the money. It's going to be dynamic. It's going to be the midpoint between the bid-ask spread. And my return on investment, if I were to buy one, that will change based upon the price. If I move this up to 60, my maximum return on investment is, it's ticking around if I were to buy. This is calculating off of the offer. This is calculating off the offer. If I were to sell, notice my probability of success just dropped. Why is that? It's 100 minus the midpoint, right? Because I'm selling. So if I were to sell this, it's giving me a 44% chance of potentially being true. Now let me go ahead, and I'm just going to go ahead and try to sell one at 50. All right. If I wanted to try to sell one at 50, I could place an order to sell one at 50. Notice how my offer is here right now. And let's see, and that's my order is still, I didn't sell it. And look, it immediately dropped. I missed my opportunity. I'm trying to sell it at 50, and look at that, it just started dropping real quickly. You can see how quickly the probabilities of these change as the price of the underlying moves. I'm going to go ahead and cancel that order. Oh, you know what? I'll leave it in. I might accidentally get filled as it bounces around. We'll have some fun. We'll see. This is all practice. Okay, I did. I actually sold one at 50. All right, so I sold one at 50. I could see my position. If I wanted to close this position, I could simply click close and just buy it back. At a market order, it's going against me. All right. I know that I sold it at 50. I could potentially make 50. I could potentially lose 50. It's going higher. Notice how it's ticking higher right now. If I wanted to get out of this trade for a loss, I could simply get out of it for a loss and just buy it back. Maybe that's what I want to do. I'm wrong. Now, I can wait. It's obviously it's moving around here. I don't know what's going to happen. It looks like it's ticking higher. Do I have to wait for it to go all the way to 0 for me to potentially profit? In fact, look at this. I was really wrong. It took off, and maybe I just want to get out of it now. I'm just going to hit close the position. Get me out. I closed it. I lost $22.50. I was wrong. I did not want to lose all 50. Okay. I don't know if it's going to come back down. Remember, here's the contract. There's still 6 minutes and 40 seconds. You can see how volatile binary options can be when the price of the underlying moves, particularly as you get closer to expiration. Now, we did get I love it. Thank you. And keep these questions coming in. These numbers in the upper left-hand corner that you see are the quantity that is currently bid for and offered. If I want to see market depth, I can click my market depth and I can see and remember, this is just a demo environment. A live environment, you might see more prices or different prices. And in fact, look at it, it's coming back down. In fact, if I could, I'm going to move to something that's a little less volatile, just so so you can see it, because these can move so quickly. Let's go to a commodity. Let's just go to gold. Here's the daily. Let's just go to gold weekly. Okay, good. All right, here's a gold weekly chart. This is going to settle in exactly 1 day. And I just want to show you, here's a binary option. Do I think gold is going to settle above 1781? If I thought yes, I could buy it. Now, if I wanted to buy this, let's put an order in to pay 58. All right, it's between the bid-ask spread. When let's say I want to buy 2 of these. All right, I'm willing to buy 2 at 58. If I place my order, notice that my bid is now here. And notice how this is now 2. That is how many are bid for. If I want to see the market depth, you can see there's some stray orders around. This is a demo environment, but that is the quantity. In the upper left-hand corner or the upper right-hand corner is the quantity that are currently bid and currently offered. And this is, again, the probability that this is going to be true. All right, and I can place my bid there, and I think it's definitely going to finish above, and it's going to either go to a 0 if it closes below, or it's going to go to 100 if it goes finishes above. Let's take a quick look at, and we'll stick with gold just because I'm on it. Let's go look at a knockout. And I'm going to go ahead and click on gold knockouts. And I mentioned that there are 4 knockouts. There's always 4 knockouts. So this is a Delta 1 product. I click on a knockout. Let's move this over. And the reason I didn't care which knockout I clicked on is because we do make it easy for you. On the left-hand side of the chart, you can cycle between the 4 different knockouts. And we mark very clearly the floor or the ceiling. Now, if I thought gold were going higher, I might choose this knockout. It's got the range 17. Let's make sure I'm clicking on the right knockout. It's got the range 1775. There's my floor, and 1825. There's my ceiling. If I were to buy one of these, look how tight this bid-ask spread is. One tick. 1784.20, 1784.30. Very tight markets. If I were to buy one at 1784.30 and it touched the floor, I would potentially lose. I would lose $93. If I bought it and it went up and touched 1825, I could potentially make 407. Now I think gold is going higher, so let's just go ahead and place one. I'm going to buy one, and I placed an order. Oh, that's that other order. Yep. Okay, here it is. I bought it. All right, so I bought one at 1784.30. Okay, great. It goes down. I can't lose any more than $93. I had to put up $93 to do this trade. I could potentially make 407. Now, do I have to wait until expiration? Now, maybe I'm willing to risk $93. I don't care if it goes down and touches it, it loses. But maybe I want to. I don't want to. I don't think it's going to make it all the way up to 1825. Maybe I want to sell it if it gets to 1800. Right below 1800. I think it might go to 1800 just because, hey, why not? Not a buy or sell recommendation. I think it's going to go up and just try to test that 1800 level. I can place a sell order, okay? And I can place that sell order above the market. So let's do it at 1799. I could do it 1799.25. Nope, I'd have to do it 1799. It's got to be an order at 10. 1799.2, 1799.20. I can place an offer way above. I'm going to place that order. Notice I'm on red, so I'm selling 17.9, way above the market. I could place that order. My order has been received. I've got an order over here to sell all the way up at 1799.20. And if it goes up there, I'd sell it. I'd be out of the trade, and I would have a profit. I'd have $150 profit. 160, something like that. So you can place an order. In fact, if I go to market depth, I can actually see my order. That's my 1799.20 to sell it up there if gold were to pop higher. And I would lock in profits if it went up there, and I know that I'm stopped out if it goes lower. I want to show you a knockout if you thought something were going, let's say crude oil. All right, let's just pick a different product. I think crude oil is going to continue going lower. All right, I don't know if that's true or not, but I might choose this lowest knockout. Let's move this out of the way so I can see it. I've got a ceiling up above. I've got a floor down below. I think oil is going to keep going lower because I think demand is going to go down. Maybe I think, okay, COVID's coming back. We're going to go on lockdowns again. No one's going to want to be driving their cars. The end of summer is coming up. I think oil's going lower. Again, I'm not no buy or sell. Let's hide the market depth. Could I sell oil? Okay, I'm going to place an order to sell it at 63.19. I'd sell one at 63.19. If I sold one at 63.19, let's go ahead and place my order. You'll see my one lot in there. Maybe I'll sell it. If I sell it at 63.19 and it goes up to 64.25, I would get knocked out $106 loss. That's the most I could lose. And if I sold it and I actually get filled at 63.19, which I may or may not, I could potentially make $394. It looks like I sold one. So I have, now I sold it at 60. In fact, here we go. We can see it. Look at my positions. I sold one at 63.19. It's calculating a loss because it's assuming I have to buy it back at the market price. Do I have to let it go all the way up to 64.25? No, I could buy it back somewhere between now and 64.25 to cut my losses. I don't have to lose all 106. But I can also say, you know what, I'm ready for it. I don't know if it's going to get all the way down to 59.25. I'd buy it back at 60.50. And if I wanted to place an order below 60.50, I'd buy that one back down below and take my profit off. Right here at 60.50 is somewhere in the chart here. I could place that order below. And you can see I've got my order to take profits. Oops, you know what? I was on sell. You know what? I just made a mistake. And notice, you got to be careful. I actually was on sell. I was on red, and I actually sold another one. So now let's go ahead and buy one back. I'd buy one back at 63. Drops down to 63, drops 15 cents. I'll buy it back at 63. Make sure I'm on blue. I'm going to place that order below. My order to receive to buy. So now I accidentally sold two of them, but here's my order to buy one of them back. All right, so I can trade. I can put bids in between the bid-ask spread or lower. I could put offers between the bid-ask spread or higher. I could trade knockouts like that. My binary options, I can definitely trade that way. And in fact, I will tell you, a lot of people, when they're trading binary options, let's just go over here and take a look at our 5-minute binaries. We got 3 minutes to go. I'm just going to pick the euro US dollar. People will, I think it's going to go higher. I'm going to buy one. Okay, and again, not a buy or sell recommendation. And let's move this to a 1-minute chart because I'm trading a 5-minute binary. All right, I just bought a binary option. Here's my position. I bought it at 30.50. Okay, great. It's going my way right now. I bought it, maybe not. I don't know what it's going to do. Now, do I have to wait for it to go to 0 if I'm wrong or go to 100 if I'm right? I might take a partial profit. It's popping higher. Maybe I sold it I bought it at 30.50. Maybe I would sell it at 40.50 and take a $10 profit. If I were to get lucky, I could place that order in, and if it pops higher, and you could see how quickly these prices move. I don't know what's going to happen. It moves very quickly because we've only got 2 minutes to go in this contract, and all of these are either going to go to 0 or 100. You can see the one below is almost trading at 100 already. The one up here is already trading at 0. Now I risked. Can you get out of these trades? Yes, you can. You can either lock in profits or you can limit losses. It doesn't matter whether you're trading binary options, knockouts, or call spreads. All right, with that, I kind of covered all of these today. I want to thank everyone for joining us. I want to thank you for the questions too. I want to remind everyone, if you'd like a copy of the slide deck, please email customerservice@nadex.com. You can request the slide deck. This recording will be available on our YouTube channel, so you can review the recording, and you can even have the slide deck in front of you when you're reviewing it. Follow us on YouTube. Join us for those morning analysis sessions. 8:45 a.m. Eastern every day. We go for 15 minutes. And in fact, an hour before that, our CEO, Travis McGee, does a 1-minute quick hit, motivational, inspirational, about, hey, here's what happened last night. Here's where you got to look. Boom, boom, boom. We actually dive into it at 8:45 a.m. Eastern and look at the charts and do a little bit more analysis. And by then, sometimes there's been some economic numbers. Any other questions for Nadex, please email. We can't help you, whether it's about your account, whether it's about our products, whether it's about the platform. Please email us. We're here to help. Thank you so much for joining, and I want to wish everyone good luck in the markets.